The wealthy don't buy life insurance because they're afraid of dying. They buy it because they're afraid of the government getting their money when they do. We're talking about a strategy so sophisticated that it makes your standard 401k look like a piggy bank with a combination lock. Here's the uncomfortable truth. The federal estate tax can hit estates over $13 million at a rate of 40%. And if your wealth is tied up in real estate or a family business, your heirs might have to sell those assets in a fire sale just to pay the tax bill. That's not a legacy, that's a liquidation. Think of it like this. Your estate is a beautiful, fully furnished house. But when you die, the IRS shows up and wants 40 cents out of every dollar of its value in cash, right now. If you don't have the cash, you start selling the furniture, and then the walls, until there's nothing left worth passing down. This is exactly where high net worth individuals, or HNWIs if you want to sound like you went to Wharton, use life insurance not as a safety net, but as a precision financial instrument. The death benefit arrives income tax-free and immediately, giving your heirs the liquidity to pay Uncle Sam without dismantling everything you spent a lifetime building. Now, not long ago, the conventional wisdom was simple. Get term insurance, invest the difference, and call it a day. But as estates have grown and tax law has become more complex, that one-size-fits-all thinking has started to look dangerously naive for the ultra-wealthy. The vehicle that's changed the game is something called an irrevocable life insurance trust, or ILIT. And yes, it sounds like something a Roman emperor would use to protect his gold. When a life insurance policy is owned by an ILIT instead of you personally, the death benefit lives completely outside your taxable estate, shielded from both the IRS and from creditors who might come knocking. Beyond estate taxes, there's another layer here that most people completely miss. Permanent life insurance allows cash value to grow on a tax-deferred basis. And you can rebalance your underlying investment portfolio inside the policy without ever triggering capital gains taxes. That's the kind of quiet, unsexy wealth building that doesn't make headlines but absolutely compounds over decades. History tells us that every generation of wealthy families that ignored these structures paid dearly for it, estates were decimated, businesses were broken up, and heirs inherited litigation instead of legacies. The Rockefellers didn't stay rich by accident. They stayed rich because they understood that the transfer of wealth is a discipline, not an event. One of the most elegant tools in this playbook is the survivorship policy, also called second to die insurance, which pays out only after both spouses have passed. Because the benefit pays later, the premiums are significantly lower, and the payout lands right when the estate tax bill is due. It's almost poetic in its timing. For business owners, this gets even more interesting through something called a buy-sell agreement funded by life insurance. If one partner dies, the policy provides the cash for the surviving partner to buy out the deceased's share cleanly, quickly, without family drama, or a distressed sale to a stranger. A common misconception is that wealthy people don't need life insurance because they're already rich enough to self-insure. But that's confusing asset size with liquidity. And those are two very different things. Having $10 million in real estate doesn't mean you have $10 million in cash when the tax bill arrives. The practical lesson here is straightforward. If your estate is approaching or exceeding the federal exemption threshold, you need a permanent policy inside an ILIT, reviewed annually alongside your estate, attorney, and financial planner, with beneficiaries clearly designated and the trust properly funded. Discipline and process matter infinitely more than finding the perfect policy at the perfect moment. The one landmine worth flagging loudly is premium financing, borrowing money to pay your insurance premiums in hopes that investment returns outpace the interest. It sounds clever until interest rates rise or markets underperform, and suddenly you've turned a conservative wealth transfer strategy into a leveraged bet with your estate on the line. At the end of the day, life insurance for the wealthy isn't about fear, it's about architecture. Designing a financial structure so intentional that your wealth survives not just your lifetime, but the tax code, market cycles, and the unpredictability of heirs who may not share your financial discipline. The goal isn't to win, it's to not lose what took generations to build. Whether you're exploring real estate investing, need contracting work done on a property, or want to connect with lenders who understand wealth building strategies, check out our links in the description below and let us help you get started.